Welcome to the Deep Dive. Today, we're unpacking the story of Allot, ticker ALLT. It's a company that's really been on quite a journey, from a niche player to maybe, just maybe, a growth story in a huge market. We're diving deep using insights from a really interesting transcript from yet another value podcast featuring Rory Wallace of Outerbridge Capital, Our Mission, to figure out why Allot, which honestly for years was called worse than dead money, is suddenly getting attention again. What's changed in its core business, these ambitious new plans, and really, why should you care about this turnaround attempt?
Yeah, let's start with the basics, where Allot came from, their foundational business. For decades, they were a niche player in networking tech, specifically for telecom operators. Their core product, something called Deep Packet Inspection Equipment, DPI. Think of it like a super scanner for network traffic. It lets carriers, apply policies, things like managing bandwidth or even charging different rates for different kinds of data.
Wow, okay, that sounds incredibly powerful. Digging right into the data stream.
Yeah.
The source actually mentioned a pretty wild historical example. A competitor, Sandvine, was apparently used by Comcast way back when to actually shut down power users.
Yeah.
People hammering things like Napster and LimeWire just to save network resources. That's granular control.
Exactly. It is powerful tech. But, and this is key, it was always a very niche market. Historically, maybe a $500 million total addressable market, the TAM, and it was dominated by just a handful of vendors, Allot, Sandvine, Procera. For years, it was kind of a Ferrari-type product, as the source put it. Operators bought it, they refreshed it, but there wasn't much growth. The market just sort of sat there. This led to stagnation, and eventually competitors Procera and Sandvine merged. That left Allot as pretty much the last man standing, in a space where the stock was, well, drifting down for nearly 10 years.
Okay, so the core DPI business was stuck. That obviously begs the question, how did Allot try to reinvent itself? Because they clearly did something. This is where it gets really interesting, I think.
Right. So Allot used their position, that incumbency and trust they had with carriers, and they pivoted, boldly, really, into cybersecurity. The goal was to deliver security as a service. SECaaS is the acronym, directly to consumers and small businesses through the carrier. And the really clever part, the vision, was to put these solutions right in the carrier's main network, which means absolutely no installation needed by the end user, none. This frictionless idea, where you literally just click a button and it's turned on, was the key. They were aiming for really high adoption rates because it was so easy.
That makes so much sense. Friction is always the enemy in tech adoption, isn't it? Make it easy, people might actually use it. But, big pivots like that, they rarely go perfectly smoothly, do they?
That's a very important point. The vision was great, compelling even, but the execution. Let's just say it hit some significant turbulence. Allot started out setting some extremely ambitious targets for this new SECaaS revenue. Like, they were forecasting $25 million for 2022, and a lot of that hope was pinned on what they thought was a huge tentpole deal with Vodafone.
And I think I know where this is going. The source mentions they had to cut their guidance. How many times? Something like 8 to 12 straight quarters in a row. That's a long time to disappoint investors.
Precisely. That's a recipe for market skepticism. For a long while, the view was just, this is a broken thesis. Simple as that. The company was burning through cash because the timelines were just way too optimistic, and maybe how they ran the P&L wasn't quite right for that phase. Stock tanked, analysts dropped coverage, you know the drill.
Okay, so why are we talking about it now then? If it looked broken for so long, what's the potential alpha opportunity here that the market might still be missing after all that?
Well, what's fascinating, and this is where the deep dive really matters, on the ground, the actual value proposition of SECaaS, the core idea, it was basically correct. People did want this. The struggle wasn't the what, it was the when. The timeline to actually implement these big carrier deals and see the revenue flow. Our research, and the source material backs this up, suggests very positive things were happening quietly behind the scenes, specifically with large deals finally starting to gain traction. Take Verizon, biggest Tier 1 carrier in the U.S. They signed a deal back in 2022. But it only launched, and incrementally at that, in mid-2023. So the revenue started small, very small.
Okay, but the source hints that Verizon is now reportedly very happy. And not just happy, but looking to expand significantly, potentially.
Right. Yeah.
What was the number? A couple $100 million in annual recurring revenue.
Yep.
That's a massive jump. And this expansion seems to have happened recently, even if it's not splashed across press releases.
That's what the intelligence suggests, yes. It points towards a significant ramp-up based on the operational rollout and feedback. It's not just Verizon either. Remember Vodafone, the original tentpole deal that caused some pain? They initially did a perpetual license deal way back in 2013, 2014. Interesting side note, Vodafone apparently made like $160 million a year from services powered by Allot tech back then. But Allot only got a fraction of that value because it was a one-time license fee. Now, Vodafone has publicly expanded the deal. They've moved to the SECaaS model, which means Allot gets a share of the recurring revenue from Vodafone's customers. That changes the economics completely. Vodafone literally had, 10 years to do something different, find another vendor, build it themselves. But they chose to upsize with Allot. On top of that, Allot has restructured, cut costs. They've actually reached a free cash flow positive cost structure now. And that's SECaaS business. It's been growing consistently, 50% plus year over year. ARR growth is accelerating. Guidance for this year is $17 to $19 million ARR. And we think it's really on the cusp of some step function moves higher early next year as these bigger contracts really kick in.
Okay, that sounds much better. But I still have this nagging concern looking at businesses like this before. Don't the big carriers, the Verizons and Vodafones, hold all the power here? They own the customer relationship, the distribution. What stops them from just saying, thanks for the idea, we'll build it ourselves now, or just squeezing a lot on price until there's nothing left?
That's a really important question. And you're absolutely right to ask it. Large tier one carriers have, professional procurement teams. Their whole job is to beat up on vendors, as the saying goes. It's a constant pressure. But success in selling to them really depends on a few things. How much value are you actually delivering? How easy is it for them to replicate? Is it commoditized? And how strategic is your offering to their business? Look, it takes years to get deeply integrated into the core network of a Verizon. It's a high barrier to entry. But the flip side is, once you're in, it also takes a very long time for someone else to kick you out. It's sticky. And Allot's magic, their key differentiator here, seems to be leveraging that DPI expertise. They scan the actual traffic in the network for security threats. Most other vendors doing this kind of carrier-level security, they rely more on DNS lookups, checking the website address you're trying to reach. That's easier to bypass, more of a commodity approach. Allot's method, looking inside the packets, is just much more robust.
Okay, so the value is significant. And it's technically harder for the carrier to replicate or swap out easily because it leverages that deep network integration. The source mentioned Verizon is really emphasizing these kinds of cloud-based security offerings lately. And apparently they show no signs, any plans to switch Allot out. Plus, you've got proof points like in Spain, right, where Telefonica and Vodafone, two huge competitors, both use Allot SECaaS successfully in the same market. Okay, let's flip the perspective. Think about me, the end customer. A small business owner maybe, or just a regular home user. Why would I pay Verizon, say, an extra $2 or $3 a month for the security service? I could get antivirus software, maybe use a VPN, or frankly, just risk it and save the money. Is this just another one of those upsells like the rental car insurance that everyone kind of rolls their eyes at?
It's a fair question. What's fascinating here, though, is it ties into this core clean pipes idea. The thinking is, shouldn't your basic internet connection just be clean, free of spam, ransomware, fraud, all that junk right from the source? There's real utility in blocking phishing attempts before they hit your inbox, or stopping an accidental malware download at the network level. The price point, $2 or $3, it isn't particularly steep for most. And critically, there's no ongoing maintenance or configuration needed by you, the user. It just works silently in the background. On the carrier's end, Allot service does quite a bit under the hood. It performs command and control blocking, C2 blocking. That stops compromised devices in your network from talking to the hacker servers. It scans traffic for those tricky evasion techniques that get around simple DNS filtering. And it even monitors for weird anomalous usage from your connected home devices. Think smart speakers, thermostats, even baby monitors. Those things can be surprisingly easy to hack and turn into part of a botnet.
Whoa, wait, a baby monitor turned into a botnet. That's a vivid picture. Suddenly my smart toaster looks suspicious. So Allot's system could actually spot that unusual surge in data from my hacked baby monitor and, shut it down?
Exactly. Depending on how the telco sets the policy, yes, it could shut off that specific traffic, generate an alert for the user. For consumers, it offers pretty robust parental controls and just general family protection from nasty stuff online. Peace of mind, maybe. And for businesses, it's a really smart, affordable layer of redundancy. Think of it as a critical layer one of security right on the telco network itself. Even if they have other firewalls or endpoint security, this adds another barrier. It's foundational.
Okay. Let's bring us back to the stock then, because that's where things get really concrete for listeners. Allot stock price has seen this huge jump recently. It was trading around, $3 back in December? Now it's more like $7.50, $8. So anyone looking at that chart today, the first, most obvious question is, did I miss it? Is the run over?
Yeah, that's the million-dollar question, isn't it? Look, from our analysis, I do not think anyone has necessarily missed the boat entirely, though you absolutely have to expect volatility with stocks like this. The reason for that big move recently is because all those on-the-ground developments we've been talking about, the Verizon expansion, the Vodafone shift, the restructuring, they're finally becoming more visible, more evident publicly. Allot's gone through some major changes. New board, new management, that big restructuring to stop the cash burn. They've actually hit free cash flow positive now. Profitability, that's huge. The old DPI business, which was at a low point, that actually looks poised for growth now too, partly because of a product refresh. And SECaaS, as we said, growing consistently over 50%, ARR accelerating, guided $17–19 million this year, and really looks set for those step function moves higher, probably early next year. The market is essentially re-rating the business. It's waking up to the fact that maybe it's not broken anymore, moving it off that really depressed valuation.
Right, but for people who have followed this story, maybe got burned before, the source mentions there were bullish write-ups, places like Value Investors Club, back in 2015, again in 2020. And those write-ups also promised big things, big subscription revenue numbers that just didn't happen. They weren't met. So the crucial question remains, why is this time different? What gives you confidence this isn't just another head fake?
That's the critical challenge, and it's fair. Anyone burned before is right to be skeptical. If we connect this back, the past optimism, those earlier write-ups, they were largely based on a top-down view, looking at the total addressable market, making assumptions, saying if they get X%, revenue will be Y. It overestimated how fast customers would actually sign up and ramp. What's fundamentally different now, or it seems to be, is the analysis is much more bottom-up. We're actually tracking, or the people deep in this are tracking, monthly subscriber additions, carrier by specific carrier. It's granular. The pond they're playing in the addressable market within their active contracts was relatively limited before. But now, with these big expansions like Verizon potentially opening up maybe 30 million business mobile subscribers compared to the 1.5 million FWA ones they started with, well, suddenly that addressable TAM within just that one contract grows by like 20 times. Plus, you have Vodafone now paying per subscriber, SECaaS, not that old one-time license fee. That's a huge step function in the quality and predictability of the economics for Allot. You really do have to be in the weeds tracking these specific contract shifts and the actual subscriber activation numbers to really appreciate why this time feels different.
Okay, and part of that different this time story seems to be new leadership. That often matters. Tell us a bit about the new CEO, Alon Harari, and the CFO, Leighton. What's the take on them?
Yes, the leadership change feels significant. I'm personally, based on the research, extremely excited about Alon Harari, the new CEO. He just joined in 2024. His background is impressive. He was the CTO at a company called Radcom. While there, he led a big tech refresh, repositioned the company, helped them land and expand deals with huge carriers like AT&T and Rakuten in Japan, and apparently he doubled their profit margins during his tenure. That's a track record. He clearly sees the opportunity at Allot, especially with SECaaS, as being much more significant than what he had at Radcom. He's seen as a credible technologist, not just a finance guy. He is strategically based near Verizon's headquarters, which can't hurt. And his past relationship with AT&T, well, you never know. That could potentially open doors for a future deal there, too. Leighton, the new CFO, also comes highly regarded. She brings that crucial financial discipline that was maybe lacking before. Both are relatively young, seen as being in the prime of their careers. That potentially offers a nice long runway for shareholders if they execute.
Interesting. Okay, what about that legacy DPI business, the original core product that was stagnating? You mentioned it might be poised for growth, and the source hinted at an interesting catalyst. What's going on there?
Yeah, this is another piece of the puzzle that's changed quite dramatically. What's fascinating is that the DPI market basically consolidated down to just two main players, Allot and their main competitor, Sandvine, a duopoly. However, Sandvine ran into some serious problems recently. They ended up on the U.S. sanctions list because they were selling their tech into some, let's say, problematic geographies, essentially helping authoritarian governments spy on their citizens. Not a good look. As a result, Sandvine has actually gone bankrupt. They're selling off pieces of their business, and crucially, they're exiting about 50% of the markets they used to operate in. So what does that mean? It means all those Sandvine customers in those markets are suddenly looking for alternatives, urgently. And Allot, as the other main player, really stands out as the strongest, most viable option. Now, telco sales cycles are slow, we know that, but we absolutely expect real deal flow to emerge from this situation over time. And this is happening just as Allot is refreshing its own DPO product line. They have a new product, the Terrace Service Gateway 3, which apparently triples the specs of the old one. Better performance, more capacity. So you've got a product refresh cycle coinciding with your main competitor basically imploding and pulling out of half the market.
Yeah.
Well, that's a wonderful setup, as the source puts it, for Allot's DPI business to rebound. Less pricing pressure, more opportunities knocking at their door.
Wow. Okay. So putting it all together, what does this mean for you, the listener, trying to make sense of Allot? We've traced this journey, right? From niche DPI player through some really rough years, trying to pivot into cybersecurity, lots of disappointment, to where they are now. A company that might be positioned for some serious growth, finally. We've looked at the SECaaS value proposition, how it's different, why carriers like Verizon and Vodafone seem to be buying in now, why end customers might actually want it. And we've touched on the new management team and these, frankly, unexpected tailwinds helping out their traditional DPI business too.
Yeah, and it raises a really interesting broader question, doesn't it? If Allot's vision for SECaaS really does take off with these huge carriers expanding it, and if their DPI business gets this second win, how does that change the role of your telco? Do they evolve from just being the company that provides the pipes, the connection, to becoming something more, a trusted, maybe even proactive guardian of your entire digital life right from the network source? It's definitely something to think about as we all navigate this increasingly complex online security landscape.
A fascinating thought to end on. Thank you for joining us on this deep dive. We hope this exploration has given you a clearer, maybe more informed perspective on Allot and the whole evolving world of network security.